on. So with no further ado, let's learn how to succeed in crowdfunding.
Awesome. Hey guys, could we get a 30-minute timer too on the timer downstage, please? Thank you. Really quick, before we jump in, this is very much a tactically focused panel. We're going to get a lot of instruction and information on what to do. If you have questions, there are note cards. I'm sure you all have phones. Please write them down. We're going to leave 10 minutes at the end for some Q&A. So we do want to engage you with those questions. So 2012, the Jobs Act is passed, and we get the introduction of Reg A Plus and Reg CF, which allowed for crowdfunding from individuals. Etan, how did Dalmore first get involved with the Jobs Act and with crowdfunding?
So Dalmore was founded in 2005. We're headquartered in New York. We're a FINRA, SEC-registered broker-dealer investment bank. We spent the first 10 years focused primarily on providing institutional investment banking and corporate advisory services to private and public companies in multiple sectors. And since the Jobs Act of 2012, we made a shift to looking to help companies raise capital primarily online at scale through regulations D, A, and CF. And since 2009, which is really when Regulation A really started to pick up in popularity, we've been quite active in the space. We have onboarded over, I think, 210 Regulation A clients, including a number of the more successful Reg A offerings that have been done to date, and been quite active on Reg CF as well.
Outstanding. Sara, same question. How did North Capital get involved in crowdfunding?
Yeah, so when Jim started the firm and the Jobs Act had passed, originally we had planned to build a platform kind of focused on hedge funds. And after the Jobs Act passed, it became clear that there was a need for regulatory infrastructure. So we developed an API stack and started developing services to be able to support the entire life cycle of a private security. So a lot of the work that we did was in Reg D to start, and then in supporting Reg crowdfunding platforms with payments, just kind of all the steps that you need to be compliant. And then with Reg A Plus kind of growing in popularity, it was just a natural extension, and frankly didn't really require any adjustment to our tech or services to kind of include that sector of business.
Outstanding. Tell us a little bit about how your relationship with one another has evolved and where you got started and what you're doing now.
So there's a number of new broker-dealers out there that have popped up over the last few years, looking to take advantage of some of the Jobs Act born exemptions. We've known North for a while. I believe they were founded in 2008. Which is kind of the time that we were started. We used to be competitors a bit. I always looked up to Jim and his team back in the day. You know, they had Realty Mogul, we had Realty this, they had this, we had that. But always had admiration and a lot of respect for their team and their reputation in the industry. So when the opportunity came to collaborate and to leverage each other's strengths, we were pretty excited about that. North provides a lot of the things that we don't provide. Things like escrow and payment processing, and they're a KYC AML provider. Obviously, they have the PPEX ATS, which we've been very active with over the last number of months. I think we're over 120,000 trades on the ATS, which is pretty interesting. And so just the culture and the flow between our teams has really been very productive. And you're at a certain point in scale, you consider vertical integration versus how to leverage others who are really successful in the space. Our model has been the later, which is really to, while we provide issuers, we look to provide issuers a seamless one-stop shop experience for primary issuance and secondary market trading. We choose to do so through collaboration and with value-added partnership, and so it's been quite an interesting ride with together over the last few years.
Any response, Sara?
Yeah, I would just add that our business models really support plugging into any of the different players in the ecosystem, which I think the slide that Dave shared earlier kind of highlights that. But in working with Dalmore, what became pretty quickly evident as we started having some really large mutual clients is just kind of the culture of service and then the solution-oriented focus around our clients to be able to continue to grow the business at scale and make sure that we're kind of delivering to our customers at kind of above and beyond. That's obviously now been extended with our partnership with Vertalo to kind of cover the entire life cycle of the security, including secondary trading. But I would say, you get, when the continuous feedback from your customer is, I had a great experience, obviously that's where you want to keep, investing your time and effort and kind of growing a partnership.
Absolutely. So if you could, walk us through the flow and evolution of a successful crowdfunding raise. Where does one start? What does it look like? Who are the parties they need to engage with? Start to finish, what does that look like?
First, how much capital are you looking to raise, right? And then whether or not secondary market trading or immediate secondary market trading is kind of baked into your business model. Reg D is used by companies that are looking to raise an unlimited amount of capital, but only from the super rich, well under 10% of the US investor population that everyone else is trying to get in front of. It takes a while to build up a meaningful network of accredited investors, and the sales cycle tends to be filled with a lot more friction. Regulation A allows companies to raise up to $75 million per year per issuing entity from anyone over 18. And there is an immediate path to potential liquidity, which is becoming a lot more relevant in this environment. It does require SEC qualification, it requires more expensive legal fees, et cetera, but it's reasonable compared to an S1. And then there's Reg CF, which allows for companies to raise up to $5 million a year from anyone over 18. There's not an immediate path to liquidity like Reg D. Reg CF has a 1-year hold. But it's being utilized a lot more by startup companies or companies with ambitions to launch a Reg A, but they want to get to market quicker and cheaper, right? And then see how it goes. Almost treat it like a test the waters strategy before they make an investment of time and resources into getting qualified for the Reg A. But as far as how to start, each one is started a bit differently. Reg D, you need to hire an attorney that basically provides you with the required offering docs. So it's something that can be done pretty quickly. You hire a BD if you want to use a BD. They provide their due diligence, and we could kind of get up and going pretty quickly. Reg A requires the hiring of a securities attorney whose primary role is to help you structure and draft your offering circular, which is called the Form 1A. Ultimately, it's submitted to the SEC for qualification. That takes time. Start to end could be 4 months plus, and you need audited financials as well. Reg CF is a bit more streamlined and quicker to get up and going. You don't have to spend a lot of money on legal for a CF. It's a notice filing as opposed to a qualification with the SEC process. So that's kind of how it works, and from a timing perspective, what the options are.
Yeah, I would just add that a lot of the discussions today in the panels have focused really heavily on secondary liquidity and providing access and pathways to liquidity for investors. One of the things to kind of focus on is where are those on-ramps for an issuer in the ecosystem and what's really their intention and focus. So a lot of the groups that we see that are leveraging Reg CF, Reg A+, and Reg D, they're looking to raise capital for their firm. So like secondary trading probably isn't a big priority unless they're wanting to utilize the fact that liquidity becomes now a value add and a value proposition to a prospective investor to be able to bring them on board. So one of the things that we've really been focusing on in trying to help structure and make it kind of reduce the barriers to entry for issuers is get them engaged with the right tools from the beginning. Because we heard on an earlier panel, the cost to switch transfer agents is a lot. It's a lot of administrative time. It's a lot it's a pain for your investors to have to now provide all their information again and go through KYC again. For a client to engage in secondary trading and look at the manual exemption. Well, if you're working with a broker for your Reg A Plus offering and you're already doing all those checks, now we just reduce that barrier. So one of the things too, in kind of going, how do you set up a company to be able to successfully engage in raising capital, but then also maybe give them the tools to help improve investor outcomes, is kind of providing the building blocks from the onset, because the cost of switching, frankly, becomes too much of a barrier to open that door for some of the investors later on.
No, it makes total sense. Assuming a small cap raise, which would you recommend to issuers, a CF, an A plus, or a D?
Again, amongst the 215 or so Reg A clients that we have, there's a very fast-growing number of what we call series issuers, or fractional share trading platforms, companies like Rally and Otis and Collectible. This is not an endorsement or a recommendation to purchase any securities.
Gotta get the caveat. Right?
But there are a growing number of these platforms that are bringing things like collectibles or single-family homes or racehorses or NFTs or athlete contracts or dinosaur bones or meteorites, literally limited to the imagination of the issuer. And to them, an immediate path to potential liquidity is important from the get-go, right? As it is to digital security issuers in general, right? $95 million worth of NFTs issued in 2020, $24.9 billion in 2021. If you want to play in the US now, Sherwood, where are you? This is not looming regulatory enforcement anymore. This is very serious. This is subpoenas. Could be handcuffs. It's not a joke. And so how do you, as closely as possible, mirror that experience of issuing, fractionalizing, and facilitating the secondary market trading of whatever you want to call them, and operate in the US? How do you do that? And so we believe that Regulation A currently is as close as you could get to that experience. Yes, you have to make sure you're not transferring from wallet to a terrorist's wallet. Yes, you have to go through KYC and AML. Yes, there's a human being element, a compliance officer that has to review and approve these transactions. So it's not that immediate blockchain movement, but it's getting closer to that. And so these series issuers really, I think we have about 30 of them now, probably 11 or 12 that are live, and more of them are now being activated as far as secondary market trading. Those are the ones that we're quite busy with North currently on.
Yeah, I think in choosing like the offering exemption, a lot of that decision really takes place with the client's securities counsel. And typically in our discussions, it's who do you want to raise capital from? There's typically two buckets. You're going to have accredited or institutional investors, or I want to be able to access retail. I want to leverage my customer base. I have a big social network. I want to be able to engage with those users and find a path to make them investors and to be able to engage with them in a more meaningful way. Well, if that's the case, well, Reg A Plus or Reg CF. And then the question goes, is continually raising money part of your roadmap? If yes, probably Reg A Plus makes sense. If no, it's a one-time raise, probably Reg CF is a great exemption. If you are highly focused on more institutional, accredited investors, you have your own pool of investors, probably Reg D. Like, I don't know why you'd go through the headache. So I think it really is very unique to the actual business and the pool of investors that an issuer, anticipates targeting.
When you bring up a really interesting point, I know both Dalmore and North Capital have talked extensively on the value and the role of community in a fundraise. Can you tell us a little bit about what that means and how one leverages a community successfully when engaging them as part of your raise?
So for crowdfunding offerings, an issuer typically would have two choices. One is, do they list their offering on one of a growing number of marketplace platforms? The big ones out there are Start Engine, Republic, WeFunder for CF, and Seed Invest, where you're listing your offering amongst many other, oftentimes competing offerings. You're paying 7 to 12% when you add up the cash and the equity. Or do you list your offering on your own domain, where you become the sole beneficiary of your own marketing and promotional efforts, where you become the sole beneficiary of the conversion of your own ecosystem of customers, fans, followers, users, subscribers. That's what we're focused on. Our experience has been that to raise capital in chunks of $500 or $1,000 on a credit card, on an iPhone, it's not about building a traditional syndicate like you would experience with a Reg D, where someone's calling their book of business with a $1,000 investment opportunity. This is about effectively marketing and promoting your offering and turning it into a business. And so, you know, and if you realize that really it's your responsibility at the end of the day, regardless of what a broker-dealer might tell you, sign up with us, pay us 7%, and we're going to introduce you to family offices and RIAs. Good luck with that. But if you, I think you'll pretty quickly realize that you're going to ultimately be responsible for effectively marketing and promoting it. You want to talk about how? You want to talk about what's working? We have a lot to share. We have a lot of data. We have a lot of case studies. But our belief is that really there's no way to get around the burden of responsibility is going to fall on the company themselves. And when you realize that, it's helpful to be the sole beneficiary of your own efforts in that way, where you're marketing your offering and your potential investors are being led to your site. You're the only one following up with them. They're not bombarded in their inbox tomorrow with 10 other competing deals, and every time they log on to Facebook with a lot of noise, right? So that's impactful and really meaningful to a lot of our issuers.
Yeah, I think if you're talking about community in terms of the service providers and kind of the ecosystem, you know, I think what is becoming really powerful is some of the processes becoming a little bit more mainstream and having, you know, having predetermined packages of services, and I use packages lightly, but where a client can come and they're not in the driver's seat of being in the middle of 5 different intermediaries' processes, but to kind of figure out where they overlap. Like what a transfer agent's going to need is going to be pretty similar to what a broker-dealer is going to need. So to have that process happen multiple times is just silly. But for the past 6-7 years, that's really has been the experience for an issuer raising capital, is they have all of their different service providers and they're trying to navigate the different rules and regulations of the different regulatory bodies that kind of oversee these different intermediaries. I think that's what's really powerful, what's kind of happening here in this room and some of the discussions we're having is, okay, how do we create synergies to be able to support more scale? And I think you really see that, like when I first started, and I was making calls to hedge funds, you know, more than 8 years ago. I mean, I was really arguing, like, why not to send a fax for subscription documents? And being able to brag that we could support investment minimums of $25,000, like that's what we were seeing. As Jim mentioned, and as other groups have mentioned, we're seeing $1 investment sizes. So when you kind of think about what that actually means in tangible processes to be able to support that scale and the application of technology, that's huge. And now what we're seeing is, okay, great, we've really streamlined this onboarding, the on-ramp into the ecosystem for the primary capital raise, but now how do we apply this same kind of concept and principles to secondary trading to be able to have settlement, to be able to kind of open the possibilities of paths to liquidity in the same way that we've done that for the primary issuance side.
Absolutely. I mean, how does the promise of secondary liquidity, how does that impact a raise on the front end? What do issuers need to be cognizant of when you think about messaging and community if they do indeed intend to take their issuance and have it trade on, say, PPEX with Dalmore as the BD? What does that look like?
Well, I would first say you would not want to promise liquidity. So you would want to, you know, really what you're doing is offering a path to liquidity, and that in itself is valuable because that frankly doesn't exist a lot of the time in alternatives. The expectation is that your capital is going to be locked up for the duration of that investment. So even just being able to articulate, look, we are working with service partners to be able to create a venue for you to have potential liquidity, I think is key, but I also think it's just as important. That doesn't mean that there's going to be demand. So I think careful messaging certainly matters, but just having that ability alone is a differentiator to probably other offerings that an investor might be evaluating.
Yeah, and also a lot of issuers don't really care. Meaning, like, if you're looking if you're a cannabis company and you're raising $20 million, and in $1,000 increments, whatever it might be, they don't want to pay a listing fee. They don't want to really even talk about secondary currently. Where we're seeing all the activity today is really in the fractional share issuers, $10 shares of a Michael Jordan rookie. You got to have the bid and ask next to it, right? Like Beckett, right? You have to give them a mechanism to build a portfolio and buy more or offer, right? And so I think it's starting in that realm right now. I think what's really exciting, and what a number of folks here are working on, is how to bridge the gap between where that is today and how that could apply more in the institutional marketplace, right? And where you'll have fractionalized funds, right? That could be, and real estate, big real estate projects that are fractionalized, and that's super interesting. It's definitely going to happen, right? And it's just starting to at this point. And it feels like this is a room of pioneers in the space. That there's been a lot of discussion over the last months and years, but it really is starting to happen. We are starting to see volume. We are starting to be contacted by companies that are, either have existing assets they want to fractionalize and then list on an ATS, or want to work with us on the primary issuance side, right? Mostly through Reg A, so they could offer those assets and build secondary solutions around them, whether it's in their own ecosystem, right? Whether they offer secondary trading to members of their own app or ecosystem, or whether they want to list those secondary securities on more of a consolidated marketplace, where that consolidated marketplace will build a potential audience that could potentially add liquidity to those securities as well. There's different models, and it feels like it's really just the beginning of this.
I'm reminded of the genesis of capital markets in America. You had to be in New York. That's where the trading happened, and then technology, it advanced the market so much by making those on the West Coast, for example, able to access them. And so it's exciting, I think, to be a part of that transformation, as especially in Reg A Plus, as you go down to folks that are 18 at $500 a time. Right? What is the most grave mistake that someone could make in a successful crowdfunding, and what would you tell people to avoid?
Yeah. Thinking that if you build it, they come. That if you launch an offering, you are an island on your own. And if you don't have an audience for that, good luck. It's if you want to roll the dice and list on a marketplace platform, same. In my opinion, it's the same thing. They're not going to market you. They're going to market their own product, right? There's a chance psychologically that you could get some momentum because they have hundreds of thousands of registered users, but they also send out emails with 10 opportunities every day. So investors go numb. You need to effectively take your message out to the masses. Crowdfunding is not for everyone. It's not necessarily for a business-to-business enterprise that's in mid-America making tractor parts. It's possible, but you're going to have to get in front of people who care, and you're going to have a compelling message that resonates to enough people to take action, not just to go to your site, but to click on Invest Now, and not just click on Invest Now, but to enter in their payment information and then sign a subscription agreement. So there's a whole process of understanding the analytics and the funnel that goes into how to effectively convert and maximize return on advertising spend when it comes to crowdfunding. That's really the exercise. It's return on advertising spend. It's understanding what is working. Another thing that's working is financial publications and newsletters that are made up of paying subscribers that are looking for vetted opportunities from different platforms. Another thing that you could do for Reg A is you could syndicate, you could co-list, right? You could list your offering on your own domain or app, but you could also list the offering on other platforms that might have an audience that might be interested, or hire a broker-dealer or an investment bank that might have a retail audience that might be interested in your Reg A offering, right? There's number of ways. There's inclusion of even influencers in a lot of ways. Some of our issuers have even celebrities, and naturally the benefit there is that they come with a big audience, right? So, so it's pretty fascinating. There's a number of ways to win, but the gravest mistake is to go through the whole exercise and assume that your network is going to create a catch on fire and everyone's going to kind of come in as a result of that. You need to have the right team in place that's going to be really straightforward with you from the beginning to set expectations right, and you need to be budgeted properly to achieve that. Unless you have a very large base of customers, fans, followers, and subscribers that you could hopefully rely on to be supportive of becoming equity participants as well.
I definitely agree with that, and I would say in terms of early steps and making decisions is maybe not gravest mistake, but most important would be finding good securities counsel. We see a lot of groups that's like, oh, my attorney said I don't need to do this filing, and I don't know if it's family lawyer or what, but clearly, someone who maybe isn't as experienced. So I think typically working with knowledgeable securities counsels, especially with Reg A Plus and Reg CF, where they're, kind of newer in the space, I think having securities counsel that's extremely experienced with that is key.
Absolutely. You mentioned something else that I think is really important in terms of the economics. What does it look like for an issuer to actually get a Reg A Plus up and running, and who are the parties that they need to be cognizant of that they will have to engage with, and what do those expenses typically look like?
45 to 120 grand for legal, depending on who you use. Big law firms will be happy to charge you 6 figures and plus. I don't think it's necessary, although I appreciate the referrals from them, so I don't want to. Yeah. But there's the average is probably 60,000 as far as structuring and drafting the 1A and driving it through to qualification. Then there's the broker dealer. We have our fees as well. And then, then there's audited financials. So if you're a new co, it's a few thousand. If you're a more established company with more complex books and records, it goes up from there. But generally, it's well under, not well under, it's under $100,000 or so as far as sunk cost to get a Reg A up and qualified, right? Reg CF is significantly lower because you strip out the legal, right? That the larger fee. You still need the audits if you're raising over 1.07 million for a Reg CF. You need audited financials as well. And Reg D is whatever your securities counsel charges you to put together the appropriate docs to go live. So it's pretty cost effective when you factor that, at least for Reg A, you could raise up to 75 million a year from anyone over 18 with an immediate path to potential liquidity, right? So that's, and then it's the marketing budget after that.
And what do you recommend in terms of marketing? Again, we've talked about the importance of
we get asked all the time. The more the better. I mean, you don't want to go in this light and then be stressed out or put a lot of pressure on the marketing company. You want to pick the right marketing company for what it is you're doing, and you want to be properly funded and leave a big cushion there, in my opinion. Because things take time to convert. This is like, it's very different than where the capital markets were in the past. Marketing means there's a funnel process. There's the initial outreach and awareness where an investor might learn about your opportunity, but oftentimes it could take 7 or 8 messages to them, or they're going to have to see it across multiple platforms before they convert. And that conversion metrics goes up depending on how many times they've seen it. So there's a whole degree of sophistication on the investor acquisition side that you see with crowdfunding, and you want to be budgeted properly. If you ask marketing companies in the space, and marketing companies are really good at marketing themselves, then what they'll tell you, I think, is somewhere between 5 and 20% of how much you're looking to raise. Be prepared to spend on marketing. Wow. I know. That's what they'll tell you.
Wow.
I've seen folks do it for less, and I've seen folks not be able to do it for the high end of the spectrum.
So last year, the thresholds for Reg CF and Reg A Plus were increased, which was really exciting. You mentioned the 1.07 million. Now for CF, the ceiling is 5 million, and the Tier 2 Reg A Plus ceiling is 75 million. About a month ago, SEC Commissioner Crenshaw made an important statement when she highlighted that from July 1st, 2020 to June 30th, 2021, so a year, that double the amount of capital was raised into private markets as it was as public markets. What are your opinions on how the increased ceilings and just private crowdfunding overall are impacting the perception of the public markets, the dreaded IPO, right? All of those processes I think that we're used to. How has crowdfunding really rocked those markets, changed those markets?
I would say what's really cool about what we're experiencing and the explosion in growth in private markets is it is so largely self-directed. And so actually for the large majority of the growth in the volumes you're seeing is from self-directed investors who are taking their own capital, not through their advisor, and investing it in companies, projects, real estate, crypto, I mean, all different alternative assets. I think it really emphasizes the need to solve this liquidity or solve the scalability and settlement and some of the issues around secondary trading. But I think that what's really exciting, I don't know that it's necessarily the raise of the ceilings, but I would say, you know, the access to information is, you know, certainly better now than it was 10 years ago. The regulatory changes that allow you to publish that information where previously you could not makes a big difference. So I think the access to information for investors and then access to be able to communicate to investors for issuers is really, you know, I think largely contributing to the growth.
Yeah, and also these exemptions allow for issuers to take their own share class structure and evaluation that they feel comfortable with to the masses. It hasn't been a very fun journey for female-owned or minority-owned businesses over the years. It's embarrassing in the U.S. for how small of a percentage of female minority-owned businesses were able to kind of get the attention of Wall Street. Today, that doesn't exist anymore. Today, you want to raise capital from your own community? You can. That's really empowering. And you could do so on your own terms. We're also seeing more sophisticated companies, issuers right now that are utilizing Reg A. Perhaps because of the increase to 75, not that everyone was killing it at 50, but perhaps it was, and it was only a 3-2 vote to get it there. But they're looking at this as an alternative in some cases to private equity and VC. They're looking at this as, I have enough confidence in my investor base or my customer base where I don't need to go and dilute myself further. Or I want the opportunity to increase my shareholder base and capitalization to meet listing requirements. So that $20 to $70 million raise pre-IPO, Reg A could be really interesting for the right participants, as it can be for existing listed companies. Right? We have OTC companies that are utilizing Reg A. They'll add a warrant, or they'll put it has to be a fixed, share class structure. But it's really opening up in a lot of ways.
Before we go to Q&A, any final statements you want to just provide on what we've talked about on the market overall? Any suggestions to the audience?
I'll say one thing, that I'm grateful for you guys, for Vertalo in particular. Like I mentioned before, there's multiple ways to grow and to evolve. You could look to become an island of your own and a fully integrated system, as a broker-dealer, and there's pros and cons to that. We chose to partner with Vertalo first because of the team and the professionalism and the reputation that you guys have, and also because we believe that you guys are building the bones of the digital asset and securities ecosystem going forward. And it's a collaborative approach. It allows for members of the community to leverage each other's strengths. And being so early in the industry right now, as we are, I think it's really wonderful to partner and meet with all of you guys, and we're looking forward to continuing those discussions.
Any
I echo
thoughts?
what Etan just said.
I mean, I will just send it right back. It truly is our pleasure to partner with both of you, and I think we have such an amazing opportunity in front of us, and done properly, done with the right regulatory mindset, done with the right technology in place, we are going to see capital markets in America change. And what an incredible honor for us to get to participate in. It's quite amazing. So with that, we'd like to open it up to the audience for Q&A. I think we have a couple runners with mics. Looks like I got a few.
Thank you. You mentioned the reasons why we think the private markets are growing. You talked about more sophisticated issuers. What about non-US issuers? Have you seen that come into any of the categories that's been discussed, and are they a factor in the growth?
Well, in order to qualify for a Reg A, you need to be either a US or a Canadian-based issuing entity. In order to qualify for a Regulation CF offering, you have to be... Sorry? Interestingly, you can't raise money from Canada, but it could be an issuer based in Canada, so it's Ontario. But we do have international companies that are speaking with their securities attorneys and coming up with a compliance structure of how to set up an entity in the U.S. They have to, there's qualifications, they have to have a presence there, they have to make their decisions out of there. I'm not an attorney, so definitely speak with them. But there are ways for companies that have a base of operations that want to open up investment opportunity to U.S. investors. There's a path that's being utilized right now, more and more so. And interestingly, with Reg A, you could also accept international investors, not from every jurisdiction, and there are limitations to be aware of. But in general, you could accept capital from accredited and non-accredited investors, both in the U.S. and internationally, rather than launching a Reg D and a Reg S and a Reg this and it's an interesting way to approach it in that way.
I mean, Vertalo, we are registered as an SEC. We're SEC registered transfer agent, and we are able to use our technology in jurisdictions outside of the U.S. Now, we're not typically registered with the securities authorities that govern whatever jurisdiction that may be, but we can certainly utilize the technology and processes that we have in place. So we have a number of clients that are international as well in Canada and Mexico, and having conversations with folks all over the world. Easy for us to turn on that functionality if the issuers are interested in a compliant raise, in ledger management, certainly in taking capital and having a broker assist with that process. So very proud of the technology and processes that we have built together, and can certainly make that available to international companies. Other questions? Alec.
One of the issues or challenges, I'd say, with Reg A is the speed to market. As Reg A plus becomes more common, do you see the SEC approval process becoming quicker?
First of all, there's no such thing as SEC approval. It's called qualification. And who knows? What we have seen is an increase in kind of like no review, kind of issuers that for whatever reason are receiving qualification quicker, which puts more pressure on the broker-dealer to get the FINRA no objection letter. But again, FINRA doesn't answer to us. They take their time as well. So we're seeing a trend for shorter periods towards qualification. The average was around 60 to 70 days to get qualified for a Reg A. So you hire a securities attorney, you spend a month putting together the offering docs, they submit the offering to the SEC, and on average it was 60 to 70 days. More and more we're seeing that duration shorten quite a bit. So perhaps, I don't know the reasons why. I wish I did. But we like to give a cushion of time for issuers to kind of based on the averages that we're seeing, set the expectations properly for them to understand that if they're considering launching a Reg A, be prepared for it to be 4 months plus, 4 or 6 months even in certain cases, and that's assuming they get the audited financials in time.
Yeah, and I would just add that's one of the things in talking about like how trying to structure kind of your sequencing to be most successful. We really emphasize with our clients, especially if you're working with the intermediaries, who are going to kind of take you through to secondary trading. We'll have calls where clients haven't even started the qualification process, and they're wanting to get into the weeds of their secondary trading build out. And that's where we, really emphasize, like, let's get this timer started, because then you have all this time to kind of get all the other building blocks in place. But if you don't have a way to get capital in, well, then, secondary trading is meaningless. So One of the things that we do in trying to balance the things we can't control, like the duration of the qualification process, is to leverage and utilize that time to be gaining momentum so that, once you get the green light, you really are able to, to go.
You could also test the waters for Reg A. And you could also consider launching a Reg D very quickly to try to bring in, whatever accredited investors you might have within your network. And you could also consider a Reg CF, which you could probably get up and running within 6 weeks or so, right? Because it doesn't involve qualification. So there's different approaches folks are using that have a more of an immediacy to kind of take their opportunity to the market.
I see Dave looming, but I think we have time for maybe one more quick one. We have right here, yeah.
How often do you see a Reg CF followed by a Reg A?
More and more frequently now. I mean, we only got involved in CF when it was bumped up from 1.07 to 5 million, as far as Dalmore's side. But we're seeing that become a more well-trodden path now.
Last one right here, yep.
Real quick. Alameen from Dex Realty in Dallas. Very informative session, Etan, Sara. We're building multiple developments in the Dallas area. Can each one be a CF by themselves in parallel, or it has to be sequenced out over a matter of time? How does that work?
You have to, factoring in common control issues aside, you are likely are able to, in general, you're able to launch either separate CF offerings, and you could also explore the Reg A Series LLC model, which allows for you to raise up to $75 million a year, but you're not issuing shares from, from the issuing entity itself. A series issuer sets themselves up to be able to offer individual assets, or in your case, let's say real estate projects or single-family homes, one after the other, asset after asset, each in its own dedicated corporate structure. In essence, drawing down from that $75 million maximum per year. Each property might be $1 million, let's say. And it allows for investors to buy shares in and build a portfolio of exposure to all of your different projects. So a series structure might be an interesting thing to look into.
Awesome. Thank you.
Thanks, everyone.